You ready? All right, so let's go through it. So the first thing you're going to want to do when you set this problem up, you want to do a graph like this, and then out like that. So just, you need to be writing this. You need to follow along. So first, set up the y-axis. Okay, the y-axis. And then what you want to do is you want to put expected return of ERP on the y-axis, and then put the standard deviation of the portfolio on the x-axis down there. I'll be writing it out. Take notes, because you're going to need to write this out on the exam. And I'm going to walk you through how to do it step by step. Okay, so the first thing is the y-x, the expected return on the portfolio, and the standard deviation of the portfolio. That's the first two things that you do. Okay. Then the next thing that you're going to do is you're going to start right here, and you're going to write RF, which is symbolic for the risk-free rate. Okay? And the risk-free rate in this case is positive. Okay? Then what you're going to do is you're going to take a line and you're going to go like that all the way through out there, a little dot out there, and then put CAL right there. That's called the capital allocation line. And then slow me down if I'm going too fast. Okay. Then what you're going to do right here is you're going to draw a dot right in the middle. Okay. And then what you're going to do is go like this. This is the way to do it. Okay. Because the students always mess this up. But it took me a long time to figure out how to do this without screwing it up. Then you're going to put this line here like that. Then you're going to put this line here like that. And then you're going to put above it that line, and then that line. Okay. And the lines need to be curvature, okay, convex. Okay. And then what you're going to do is you're going to do U1, U2, and U3. Okay. And the U means utility. These are called the utility curves. Okay. Now, very simple question. If you were an investor, where would you like to be in this spectrum? Do you want to be over here, a high-risk portfolio at low return, high return, high risk, or low risk and high return? Okay. But the problem is there's nothing out there. There's nothing in the marketplace that I can construct, that I can assemble a portfolio out of that's going to give me high return and high risk. Okay. So what investors have to do is they have to lower their utilities. That's where these arrows come in. So they lower their utilities to the point where the utility curve is tangent to the capital allocation line. Okay, so that's the first step. All right. Then the second is you want to draw this, which is called the efficient frontier. And the efficient frontier, the way I would draw it, is that I go right back here to the dot, which is, I put an M right above the dot, and that's called the market basket. That M is called the market basket. And then here, right at that dot, what I would do is go like that and put a dot right there. And then what I would do is I would take do this line right here and put a dot right there. You guys are going to be financial economists in this exercise. This is called right here. What I would do is go like this, and then I go like this. This is called the efficient frontier umbrella, because it looks like an umbrella. Right? And then I put little dots on the end of these things. Here, and then I'm going to put dots inside the efficient frontier. And then what I'm going to do is I'm also going to put some dots right here along the efficient frontier, out like this, out there, here, there, some dots. Now these dots are basically portfolios that I can construct using assets that are available in the marketplace. And then inside the umbrella are the individual assets that are available to me to construct these portfolios out of. Okay? So we have the capital allocation line, we've got the utility curves, we got the efficient frontier. Okay? This is the risk of the portfolio, this is the return on the portfolio. So right here, this portfolio, right at the end here, you want to write 100% stock. So that's 100% stock portfolio. Okay. And then down here, what I do too is I put the dots in. So once I get the 100% stock portfolio, I'm going to take the lines down, and I'm going to put a standard deviation, and I'm going to write stock. Okay. And then what I'm going to do is I'm going to draw the lines here across, and I'm going to do ER, expected return, on the stock portfolio. Okay. I'm basically laying out the risk return associated with 100% stock portfolio. And as you can see, 100% stock portfolio is going to give you higher return, but also going to give you higher risk, measured by the portfolio standard. And then what I would do, tell me if I'm going too fast. Yeah? Okay, everybody should be drawing these out, because I'm going to be looking for this. I'm looking for detail on the exam. And then down here is 100% bond portfolio. And as you can see, the bond portfolio has significantly less risk than the stock portfolio, but it also gives you lower expected rates of return. And the return on the bond portfolio has to be higher than the risk-free rate right there. Yeah, the 100% bond portfolio, the expected return should be above the risk-free rate. Right here. So, right there.
So what does it say in black about that?
Yeah. Which one right here?
Yeah.
Yeah, this is bonds.
Right above it?
This is the expected return. ER is the expected return. I'm using abbreviations. So if you don't understand any of the abbreviations, just let me know. Okay. Any questions? Okay, got it. All right. So let's say I own a 100% stock portfolio, and I want to reduce my risk, and I'm willing to take a lower rate of return. What I would do is I would sell off my stocks and start buying bonds. I'm going to reduce the rate of return on my portfolio, but I'm also reducing the risk in the process. So my real motivation was to reduce risk, and I'm really not interested much in return. So what I'm going to do is I'm going to move down the efficient frontier by selling off my stock and buying more bonds. Okay. can do too, if I have 100% of my money in bonds, and I want a higher rate of return, and I'm willing to take on more risk, I'm gonna be selling off my bonds and buying more stock. So I'm gonna increase my allocation to stocks and reduce my allocations to bonds. Okay. So you can move up and down, you can move out, and you can move down the efficient frontier by basically changing the mix of your portfolio between stocks and bonds. Okay. Now we're starting to have fun. Okay. All right. So what we can do also is we can jump off the efficient frontier. We can jump off this efficient frontier up onto the capital allocation line and move up the capital allocation line. Now, why would we want to do that? Well, we want to do that to get higher rates of return. Okay? So we can jump off the efficient frontier onto the capital allocation line and actually move up the capital allocation line to a point that's going to give us significantly higher return on the portfolio, but we're also taking on significantly more risk, because what we're doing is we're using leverage. Okay? We're using borrowed money to lever up the portfolio. Okay? And the way that we do that, if I have a stock portfolio, I can lever up the stock portfolio by borrowing margin from the brokerage firm, basically taking out a loan to buy more stock from the brokerage firm. So I want to buy $100,000 worth of Apple, or actually I want to buy $200,000 worth of Apple, but I only have $100,000. So I go to the brokerage firm and I say, will you lend me $100,000 on margin? We'll use the securities as the collateral. You give me another $100,000 and I'll pay you 9% interest. So now I can buy $200,000 of Apple instead of $100,000 of Apple. When you leverage up the stock portfolio, what happens when you use leverage, what you're doing is you're using borrowed money to invest. And when the prices go up and you're using borrowed money as leverage, the return on equity goes up exponentially. That's why everybody loves the leverage. Okay? But the problem is, if prices start to go down, your return on equity goes down exponentially. So leverage is a two-edged sword. It's great when it works, but it can turn against you. Also, you can jump off the efficient frontier and move up the capital allocation line through the use of leverage when you buy your real estate. Now, your grandparents and parents are not going to buy a $800,000 home without a mortgage, right? 9 times out of 10, we got to put up 20%, and then the other 80% is going to be a mortgage from the bank. So basically what you're doing is you're leveraging up your equity in your house by using bank financing. Okay? So you can jump off the efficient frontier and move up the capital allocation line to get higher rates of return, but you're taking on more risk through the use of margin on your stocks and mortgage on your real estate. Now, if the prices go down on your stocks, the brokerage firm is going to call you up and say, we got a margin call, you don't have enough equity in your account, you got to put up more equity. If you say no, they're going to sell your stocks and they're going to pay back the money that you borrowed. If you're bought a piece of real estate, a home, and you can't afford to pay the mortgage payment on the mortgage, then you default on the mortgage. If you default on the mortgage, the bank's going to basically foreclose on the property and take it from you. Okay? So it's a little bit different. Okay? So that's how you can get higher rates of return, but at significantly higher risk. For the banks, you can also jump off the efficient frontier here, down here, through the process of what is called lending. Okay, through the process of lending. So this is right here. So when you lend, you jump off the efficient frontier and you move down the capital allocation line. Now, why would you do that? This is what banks do and brokerages do. So by lending mortgage and margin money that's collateralized and secured by the assets, they're significantly lowering their risk within the portfolio, but they're also getting less return. But they're actually reducing their risk more than they're reducing their return. Because really the lenders, the banks, are more worried about defaults and risk than they are really in returns. Okay, I think we're doing pretty good here.
Wait, can you repeat that? You said lending's going from the capital allocation
Yeah,
line
so,
jumping to
yeah, so you're on the, let's say you're here at the market basket, and you can jump off the efficient frontier onto the capital allocation line and move down the capital allocation line through the process of lending. Okay? And the banks and the brokerages are really reducing their risk more than anything, because through the process of lending, those loans are secured by not only the securities, but also the mortgage. So they're asset-backed loans. They're secured loans based on some underlying asset. Okay. Any questions? No? Okay. So let's talk about this market basket right here. Make sure you put in the dots. Right, so right here you have the expected return. For lending, you have the lending portfolio standard deviation. This market basket right here, you want to put the lines in. Expected return on the portfolio and put a star. Right here. And then do the lines that go down here. Put the standard deviation on the portfolio, star. So this is your return to risk. Okay? This is your return to risk. Now if you take that point, that's the market basket. This point right here is the market allocation. So what percentage of the market, the stock and the bond market, what percentage is bonds and what percentage is stock? And then that's what this portfolio is. It's the market basket. What it's called. And it's basically a pie chart that takes the value of the assets in the marketplace and basically sums it up, divides it back, and gets a percentage. And I'll talk about the market basket and how it's changed over time. So because as new asset classes emerge over time, the market basket changes, and people try to replicate those market baskets as new asset classes are introduced, and I'll go through that in a second. So this point right there, from the equation standpoint, is the expected return on the portfolio divided by the portfolio standard deviation. So it's your return to risk ratio, or it's your risk-adjusted rate of return. At this point, right here, you're getting the highest risk-adjusted rate of return. Let's talk about the composition of the portfolios, okay, over time. So when I first got into business in 1945, I'm 80 years old now. Somebody erased this in my last class, so I'm going to have to go back and rewrite it. In 1945, between 1945 and 1970, when we were building portfolios on behalf of our clients, there was really only stocks and bonds that were available. So we built the portfolios based on stocks and bonds. And the allocation between stocks and bonds were 70% bonds and 30% stocks. So that was the market basket back then. And then in the 1980s and 1990s, in that time period, a asset class that had been around a long time, that had never been really recognized, there was some research done by a company called Ibbotson and Associates. And Ibbotson and Associates basically took the mathematics behind this and cranked it through their software at the time. And really technology, desktop computers and advancements in mini and mainframe computers at that time, really started in the 1980s. So a lot of the mathematical calculations around finance had never been applied because you didn't have the data processing computational capabilities and the storage capabilities until the 1980s. So Ibbotson and Associates did the research, ran the calculations, and said, hey, you need to have at least 10% of your portfolio allocated to real estate. Okay. So what they did, since real estate smells and looks like bonds in its characteristics, although real estate has more of an inflationary hedge component to it than bonds do, Ibbotson said, hey, you should have at least 10% of your portfolio allocated to real estate. So they took 10 percentage points from bonds. They kept the allocation of 30% for stocks, and they allocated 10% to real estate. This could be commercial real estate, residential real estate, equity or equity using mortgage, direct real estate purchases as opposed to buying real estate securities. And then actually in the 1980s too, not only did Ibbotson's research institutionalize real estate as an asset class, but also there was a legislation called ERISA, which was a labor law, that basically stated that pension funds had to allocate at least 10% of their assets into real estate. So it institutionalized real estate as an asset class. In the 1990s to the 2000 period, Ibbotson did the research again using the analytics and said, hey, you need to have at least 10% of your portfolio allocation in cash value life insurance. So what they did, since life insurance looks and smells a lot like bonds, they took the allocation from bonds down, kept the allocation for stocks, kept the allocation for 10% for real estate, and then added an allocation for life insurance. And the life insurance is not term insurance, it's permanent life insurance, cash value life insurance, offered by mutual insurance companies that are not publicly traded or private. So the life insurance became legitimized by Ibbotson and Associates. And actually the life insurance investments became institutionalized in the 1990s because banks, large banks, what they would do is they would put life insurance, permanent life insurance, on their top employees and pay the premiums. And every time they paid a premium, the policy would accumulate what is called cash value, which is highly liquid. And if the principal passed away, the death benefit would go to the bank as a backstop. So the cash value, the regulators, the banking regulators, said that that cash value in those life insurance policies on your employees would be considered tier 1 liquid capital and would be counted in your liquidity ratios that are calculated by the bank. So that legitimized life insurance. Then in 2000 to 2019, a new asset class has emerged that looks and smells a lot like bonds and real estate, and a little bit like life insurance. And a company called Deutsche Bank and a company called Reef basically took the Ibbotson analytics and reran the model and said you need to have 10% of your portfolio allocated to alternative renewable assets, alternative renewables. So they took down bond allocation to 40%. They kept the allocation to stocks at 30. They kept the 10% allocation to real estate. They kept the 10% allocation to life insurance, and they added a 10% allocation to alternative renewable energy assets. Alternative renewable energy assets. Can you give me what some alternative renewable energy assets would be?
Solar power?
Solar, wind, geothermal, biogas. I probably wouldn't throw nuclear in there, but those are the renewables. Renewables are extremely, they're going to become a dominant. I mean, the state of California is going to, in 2050, 100% renewable mandate. They're, you know, at the, what the, where are they now, in Europe, at the United Nations, right, talking about climate change and improvement with renewables. So the whole economy, I mean, the whole portfolio allocation is going to change towards renewables going out over the next 40, 50 years, or else we're going to go up and, you know, torch, right, become raisins. This portfolio allocation right here is the new market portfolio. This is now going to be the target or the model portfolio for you guys. This is your portfolio allocation. Because you guys are going to be working the next 40, 50 years, and you're going to need to allocate your portfolio appropriately. Okay. Now these three asset classes, right here, the real estate, life insurance, and the alternative energy, these asset classes are called alternative assets. They're alternatives. So they're backed by hard assets, physical assets. And the reason why you would want to include these alternative assets in your stock bond portfolio is because they have low, no, and negative correlation with returns on stocks and bonds. These alternative assets have no, low, and negative correlation with returns on stocks and bonds. So if you add these alternative assets to your stock bond portfolio, you're going to get diversification. Okay? Now here's the beauty of this whole exercise here, is if we add these allocations into the stock bond portfolio, what happens is the efficient frontier actually bows out. The efficient frontier bows out. So this is like the first thing that I'm going to be looking for when I look at your exams. So I'm looking for the bowing out of the efficient frontier. I'm looking for the umbrella. I'm looking for the dots. I'm looking for, you know, as much detail as possible. So again, because these alternative assets have low, no, and negative correlation with stocks and bonds, it bows out the efficient frontier. It reduces the expected return on the portfolio, but significantly reduces the portfolio standard deviation. Reduces the portfolio standard deviation and the risk of the portfolio more than the reduction in the rate of return. That's key. So if I can reduce the risk within my portfolio more than the reduction in the rate of return, I'm going to increase my risk-adjusted rate of return. That's what investors want. You can reduce the risk more than the return and give me a decent return and increase my risk-adjusted rate of return, I'm going to be better off. And what investors really want, they really don't want much. What they really want is for you to perform as a portfolio manager and to give them expected returns of between 8 and 10%. And if I can provide my client a 10% rate of return annually forever, based on the rule of 72, which basically states if you take 72 and divide it by 10, I get 7.2 years, which basically means if I can get my client a 10% annual rate of return forever, they're going to double their portfolio in 7.2 years. So if I can lock in this expected return and reduce the portfolio risk significantly by including alternative assets within the portfolio, I can increase the risk-adjusted rate of return, and I can get an 8 to 10% rate of return, and I can double their money in less than 10 years. That's what they want. That's what the majority of risk-averse investors want. If you can do that, the money's going to flow into your firm, and you're going to get assets under management, and you're going to charge asset management fees, and you're going to get all this money, and then you're going to have a house in Carmel and Tiburon, and driving around in cars, and your kids are going to be going to St. Mary's and other private schools. Okay, so that's kind of the goal here. All right. Okay, here's the other thing that's really interesting, and a lot of this stuff I didn't recognize, from the book, because I worked in alternative renewable energy consulting for like 10 years, and we did the research around this and introduced this into the model. And then the last piece that's really super interesting is I have a client that, multiple clients where we built these portfolios before and allocated, built the portfolios. Now these individuals, this one woman, she's a principal. She's probably like 50 years old, highly professional. She sits on multiple nonprofit boards and also donates money to the nonprofits. She sits on multiple corporate boards and runs multiple of her own companies. She basically runs her own family office, okay, where she's basically taking money from the family to invest on their behalf, plus family and friends' money in the process. So she oversees the family office portfolio. And then she also obviously takes care of her family and probably helps out her brothers and sisters' family too. So this woman is extremely critical to the network of institutions that she has around her. And if something was to happen to her, it would be extremely destructive, and destroy a lot of wealth and a lot of human capital in the process. So the only way that you can hedge off mortality risk is to put life insurance on the individual, to basically protect the institutions and the families surrounding her if something was to happen to her. So what we do is we get her $25 million of life insurance, so that if anything ever happened to her, the death benefit would come in, and basically the executor of the estate would be able to use that money to hire replacement people to keep the institutions and the companies functioning, to be able to pay off the taxes on the assets and pay off all the personal debt and business debt associated with the companies, and basically leave the estate to the heirs with zero taxes and zero leverage at a stepped-up basis. That's the goal. Okay? That's the strategy, that's the goal. So if the individual passes away, the life insurance death benefit kicks in, is injected into the portfolio, or the estate. The expected returns on the portfolio jack up onto a higher utility curve for the beneficiaries of the estate and the portfolio, and they end up on a higher utility curve with higher risk at a lower given level of risk. A higher rate of return at a lower given level of risk. Now, isn't this where we wanted to be originally in the very first part of the exercise? So it was life insurance as the financially engineered product 157 years ago that basically allowed the individual to protect herself and protect her family against mortality risk. It's freaking brilliant. Insurance products, in my view, are probably one of the most brilliant financially engineered products ever invented. And who was the motivator? Who motivated the financial industry and government to basically give preferential tax treatment for life insurance policies? It was the very wealthy families on the East Coast, in Boston and New York. Families in LA have taken advantage of these strategies. Families in Silicon Valley have taken advantage. San Francisco. It's basically an engineered product that allows you to be able to transfer wealth tax effectively and tax efficiently, to be able to maintain standards of living and allow for the people and the human capital around you to move on at a higher standard of living. Frickin' brilliant. Somebody have a question?
Why don't we put more in life insurance then?
You should.
Like, why, but their study is like 10%, why isn't it like 20 or 30?
They said that's just the minimum recommendation.
Yeah, that's like the
Okay.
minimum recommendation. It's the minimum recommendation. If you're a really highly risk
Yeah.
person, and you take a lot of risk and you do a lot of things,
Yeah.
you probably wanna bump up the life insurance.
Okay.
It's not cheap. I mean, the premiums are expensive, so it's gonna reduce your expected return, and that's one of the biggest objections, is people think that they can beat the market by investing the money outside of a life insurance policy.
Yeah.
And 9 times out of 10, they can't beat the market. So life insurance is a guaranteed payout, especially when you buy a permanent life insurance backed by a mutual insurance company, like New York Life or Western or Ohio. Okay. But I have a lot of clients, at different levels that say, hey, I'm young, I don't need life insurance, why would I get life insurance? I don't have a family, I don't believe in life insurance, I can take the money and beat the market. Those, in my view, are just excuses. I recommend that all my students get at least $1 million worth of life insurance, because it's only gonna cost you like $500 a year. And the premium's not gonna change over a 30-year period. And if anything ever happens to you, the $1 million will take care of your family. So at the end of the day, do you care more about yourself or do you care about your family is really the issue. $500 is basically less than a beer budget, right, for a month for some of you guys. So, it really doesn't make sense why you wouldn't do it, so that if anything did happen, everybody around you gets taken care of. And I do believe that your parents and probably your grandparents have invested a lot of time and energy and money into you to get you here, in anticipation of you going on and becoming extremely successful in your career, and maybe end up taking care of your parents at some point in the future. They may actually think that. But if something was to happen to you, if you got leukemia or cancer, or got shot or killed or run over, or a car accident or something, this stuff happens. I have clients that this has happened to. And it's devastating to have to go deliver the death benefit to the clients. But I'll tell you one thing, I'd rather deliver death benefit checks to the family than not deliver it at all. Because I know they're screwed if they don't get the death benefit check. Because everything that you invested in you is not going to materialize. Okay? And that check will come in handy to send Johnny and Ginny, to a really good school and pay off the mortgage so that your parents can live, an easier life for the rest of their life.
What would casualty insurance fall under?
Disability, casualty, disability insurance, casualty insurance. So if something happens to you, trip and fall, you basically can't work, then the insurance company is going to claim the insurance and it'll provide you a supplemental income until you can go back to work. It's not going to be enough money to live off of, but at least something that'll be able to pay you so that you can have some money to come in to cover your basic expenses. Okay? But when you go on to work for a company, and and move up in the company, they're going to put life insurance on you. They're going to put disability insurance on you. If you're going to do a startup company and raise $5 to $10 million, they're going to want to put life insurance on you. Because if something happens, they're going to want their money back. And if you have a pre-existing condition and you haven't gotten your life insurance, you can't get life insurance and you may not actually get the startup money. Because they want the insurance money to backfill if something was to happen to you, because you have all the IP in your brain. Okay. Any other questions? Okay. That's kind of a sobering conversation, but you guys are all adults now, so it's time to have these sobering conversations. Okay. What's interesting too, and then I'll move on really quickly, is I can bow out the efficient frontier, reduce the expected return, but reduce the risk more, and increase the risk-adjusted rate of return through portfolio diversification by adding alternative assets to the portfolio, because they have low, no, and negative correlation with stocks and bonds in the portfolio. I can also bow out this efficient frontier through the use of financial engineering. I can basically take derivative contracts that you've studied already in the class for your memos, and I can take those derivative contracts and put them together, put these tools together to basically apply portfolio insurance onto the portfolio. So if I think that the asset values of the assets in my portfolio are going to fall, I can financially engineer the solution, which becomes the portfolio insurance, through the tools of the derivatives. So for example, if I think prices are going to go down or returns are going to go down in my portfolio, and I have assets in the portfolio that are correlated to these indexes, I can write the forward contracts, write the futures, write the calls on futures, and buy the puts on the futures. And I can hedge off the risk in the portfolio, lock in the expected return, and reduce the risk significantly, and increase the risk-adjusted rate of return in the portfolio. I can do that. And if I own exchange-traded funds and stocks in my portfolio, I can sell short, I can write the calls, I can buy the puts. I can also write credit default swaps, maybe swap contracts. This is more my investments class, but I can actually take these derivative contracts and engineer them to basically immunize my portfolio against downside risk, since I know we're going to be in a recession in the next 24 months. So I probably want to start implementing these strategies to immunize the portfolio for downside risk. And as we know, if I think the prices are going to go up on the indexes, I'm going to buy the forwards, buy the futures, buy the calls on the futures, and write the puts on the futures. For the ETFs, I'm going to buy on margin, buy calls, write puts. So basically, that exercise just answered the last two questions, the two questions in the exam. Right? This one was modern and postmodern portfolio theory. The book touches on it, but it's not an application. It's just a theoretical example. This is actual application. This is what we've shown institutional investors. And then the next question talks about the derivative trades. So if the prices go down, the indexes go down, or the ETF and the share prices go down, you write forwards, write futures, write calls on futures, and puts on futures for the index, or indexes. For the ETF and the stock prices, you're going to sell short, write calls, buy puts, and that's it. Don't worry about this stuff. So that answers that question. Then the next is the technical analysis. Does anybody have any questions? Do I need to go over this? The more detailed, the better. Okay. And then show me the progression and the changes in the market basket over time. I'm going to be looking for the bowing out of the efficient frontier, reduction in the expected return, more reduction in the risk, higher risk-adjusted rate of returns, and I want to see the death benefit effect on the portfolio that allows you to get to a higher utility curve at a higher risk, at basically the same, at a higher return at the same level of risk. It's basically a windfall. Unfortunately, you have to die to take advantage of it, but at the end of the day, when you're running institutions live a long time. We're basically just fiduciaries. We're just serving the long-run institutional, because I want my family and I want the pensioners to do better. My goal is just to be a good manager. I'm willing to, if something happens to me, I'll take care of the institutions and the people around me. Okay, any questions? No. Okay. The next one is technical analysis. How am I doing on time? Okay, cool. Yeah, we should be able to do this. want to do that over there. So let's do the technical analysis. Technical analysis is hard too, because you got to do the graph exactly the way it's done, or else it's going to look all funky. And usually, students will just scribble on the exam and not really do it the right way. Again, this exercise, this whole exam is really a test of attention to detail. And if you look at all the job descriptions, the first thing that it says in the job description is attention to detail. Okay? And then who knows, maybe one of these days, you know, you'll be making a presentation in front of somebody and you'll have to jump up in front of a whiteboard and start diagramming stuff. Okay? So getting up in front of the board and doing these things or drawing this stuff out by hand, not PowerPoint, is more powerful when you're illustrating these examples in front of a group of individuals. So this is the technical analysis. Again, simple. What I would do is do this. And then like that. And then actually, it goes like that. So that's how I would probably set it up. And then this, before I get into the actual technical analysis, what we're learning in this class is fundamental securities analysis, fundamental analysis, same thing in your economics course. But we as managers are constantly looking for trends in the data, either financial ratios or price data or economic data. So being able to identify trends and patterns within data graphically is extremely important. Okay. So this right down here is the volume. This is the volume chart. Okay. This one down here is called the RSI. And this one up here is called the MAH01658. And these are basically moving average measures that are basically taking moving averages of the price trends. Okay, so they're indicators. This is what we trade off of as traders. Okay, we use price charts. Okay, and I've already done that. You've gone up to stockcharts.com, bigcharts.com, and gotten 3-year charts. Okay, those are the technical charts. Now we're going to do the technical analysis. So let's start down here. So this is the price. Let's say Yahoo. So I'm going to trace out the last 3 years of Yahoo's price. So it'll go like this, right? Because it moves up and down on a daily basis. And it goes down, then it goes up, then it goes down, then it goes up. Okay. So you see how it's not falling below. This right here, when you see this pattern, this is called the support line. And you see how this keeps bouncing off the top, right, but it doesn't break out. This is called the resistance line. Okay. This range right here is called the trading range. This is called trading range. The traders would say that the stock is range bound. Technical analysts also say this is a consolidation phase. There's really nothing moving the stock, so the stock is actually consolidating within this range. So it's the consolidation phase. And it's also called the accumulation phase too. Then all of a sudden news will come into the marketplace on earnings or interest rates or something, and the stock will break out to the upside. Right? It'll start to move, then maybe it consolidates again, then it sort of breaks out, and you can see it's forming another support resistance, then it moves up, moves down, maybe hits a peak, moves up, moves down, down again, moves into a range, breaks down again, hits another support, and then boom, goes down again. So as you can see, that support looks like that support. That's what happens. this prior resistance is this current resistance. So you see these recurring patterns that occur within these stock charts. And this is good. Oh, sorry, that's the support. Sorry. Got it. So there's the support, the resistance. And then right here, this point right here, that's where the stock broke out to the upside. This is all terminology. So that's the breakout to the upside. Okay. This is called the shoulder right here. This is called the shoulder here. This is called the head, or the peak. And you can see this was, this resistance right here became a support line, right here. You can see that became a resistance line too. You can see here that it broke out. Breakout. Breakout to the downside. This is another consolidation phase or trading range. Resistance, support. You can see that over here, the stock started to basically accumulate or hit another support here. Back where the support line was 3 years ago. It hit, kind of bounced off the support, and then broke out again to the downside. As you can see from the chart, that the stock was in an upward trend. Even though it kind of moved around, it was still in an upward trend. And then the stock went into a downward trend. This was Yahoo. Okay, Yahoo did this. Then what you see also is when stocks go into these consolidation phases, the volume, the trading volume in the stocks basically starts to flatten because there's really no interest and the stock kind of bounces around. Then when people hear the news, they go in, they rush in to buy the stock, and then the sales, the purchasing volume, the buying volume in the stock starts to increase as the stock price starts to go up because more people are buying. And then when they get into the consolidation, the volume starts to come down. Then when you get into the peaks again, so volume charts are indicators of interest and momentum in the stock. It's another technical indicator that's used. And then the RSI and the MACD indicators, basically the RSI indicator will be kind of flat here, and then as the stock price goes up, it will go up, and then flatten out, and then go up again, and then as the stock price starts to go down, then it goes down. So this is a trading indicator, the RSI. And the RSI and the MACD kind of do the same thing. But if the RSI and the MACD are trending down, then the stock price is probably going to go down. If it's trending up, it's probably going to go up. Okay? And there's about a half a dozen technical trading theories around these charts. The oldest and the most popular is the Dow theory, based off of the Dow Jones Industrial Average, so it's been around over 100 years. The other is momentum. It basically states if stock prices are going up in a solid trend in conjunction with volume, they're probably gonna continue to go up. So it's based on momentum. The other is I can use regression analysis, or I can use moving averages, I can use exponential. Moving averages is a tool to be able to forecast where stock prices are going to go. And then the last method, which works really well too, is called the Wyckoff method. If anybody's interested in trading and learning technical trading strategies, Golden Gate University has a whole certificate concentration at the graduate level. It's been around for like 30 years. Hank Pruden invented it. I took multiple classes from him years ago, God bless his soul. But basically, showed how you could use technical analysis in conjunction with fundamental securities analysis, which you're learning, combine them together, and actually create very solid trading strategies to accumulate wealth. Okay? So that's basically it for the technical analysis. And then the last one is the intrinsic valuation theories. Okay. How many theories are there? 4. And what are they? How much time do I have?
15.
So there's 4. So there's 4 intrinsic valuation theories. The first one is the perpetuity model. And the perpetuity model is pretty simplistic. So I can take the cash flow next year, right, T+1, and cash flows can be earnings at the company level. I can do earnings per share at the share price level. I can do EBITDA, earnings before interest, taxes, depreciation, amortization, or free cash flow at the enterprise level to get the value of the company, or I can do it per share. The 2 that I want to use is the numerator to get the valuation of the company or the share. But you always want to use next year's projected cash flows. And we'll do this around the midterm. We'll do like 12 problems, case studies. You've already been practicing these things in your chapter 9, but we'll go over it again in more application for the midterm. So you get the cash flow divided by I, okay, which is your discount rate. It's called the discount rate, or it's also called your expected return. What we'll learn later on is that the expected return, the discount rate that we use in this calculation, we could use what is called the capital asset pricing model, or what's called CAPM, which you did on your pretest, which is equal to the risk-free rate plus the beta times the return on the market minus the risk-free rate. So we could use that equation, and I'll go through that a little bit later. That's just a little footnote. And then it's going to be next year's cash flow divided by your expected return is going to give you the value of the company or the value of the share using the perpetuity model. And the assumption is that these cash flows, perpetuity model assumes that the cash flows are going to remain flat and constant forever into perpetuity. So the model becomes very simple. It's just next year's cash flow divided by the expected return gives you the value. So this is a conservative approach to valuing either a company or a security, okay? The next model is the Gordon growth model. And the Gordon growth model is very simple too. It's just like the perpetuity model. It's also called the constant growth model, but I like to give, Gordon his due since he invented, the model years ago. So it's the Gordon growth model. The Gordon growth model basically says that you take the cash flow, whatever it is, next year, and divide it by your expected return minus the constant growth rate in the cash flows forever. Okay, so this assumption is not that cash flows remain flat forever, it's that they're going to grow at a constant rate. And the equation, if you did the calculus, you rearrange it, and it deduces to I minus j. Okay. And if you do that, it's going to give you the value using Gordon growth. And you need to remember that if the growth rate expectations in the cash flows go up, the value goes up. The expectations in the growth rate in the cash flows go down, the value of the company or the shares go down. Okay. The next model is the multiple approach. Got it. You take the same cash flow, T plus 1, and you're going to multiply it by some multiple, and I'll give you some examples of what the multiples are in a second. And these are going to be forward-looking multiples. So some multiple times the cash flow is going to give you the value using the multiple approach. And I believe on the pre-test I asked you to put in an example, just to calculate some example. Now, the multiples, okay, this could be the, if I'm doing a company, this would be the sales price of the company divided by the EBITDA. So this is company level, this is a company level multiple. So if I know the cash flow that's going to kick out from the startup company that I'm working with next year, and I know what the sales price is of the companies that have just sold recently, and I know what their EBITDA is, I can calculate the multiple and apply it to my cash flow for next year and to get the value of my company. Okay. For stocks, what I'm using is stock price divided by the earnings per share. This is called the price earnings multiple. So if I forecast what earnings per share is going to be for a company next year, and I know what the price earnings multiples are for companies just like mine for next year, I can apply the price earnings multiples for my peer group onto the projected earnings per share for next year for that company, and I can get an estimated stock value for the company using the multiple approach. Okay. And there's two other methods of calculating multiples. One is 1 divided by I, and 1 divided by I minus G. So I can basically create multiples using the perpetuity and the Gordon growth model. And actually when I calculate the multiple approach, using these as multiples, this multiple times the cash flow is going to give me the same value as the perpetuity. This multiple times the cash flow is going to give me the same value as the Gordon growth. So we do it both ways. The investment bankers do it this way. We do it this way because we're trying to teach you the theory behind it. And then the last model, how much time do you have?
7 minutes. 6, 7.
Is the discounted cash flow or DC. Now the simple equation for the DCF model is you take the sum of the cash flows over the holding period divided by 1 plus I to the n. So this is basically the present value calculation. So you project it out, and then you take the 1 divided by I to the 1, 1 divided by I to the 2, 1 divided by I to the 3. Those are the discount factors. You discount the cash flows to the present, you get the present value of the cash flows. Okay. Then you add the terminal value, 1 plus I to the n. You discount it all back to get the present value, PV, of the discounted cash flows. Okay. And what I'll do later is we'll go into more detail on how to calculate the terminal value. And then you take the terminal value, you add it to last year's cash flow, you discount all the cash flows, and you get the present value. So I can use this discounted cash flow model to estimate the value of the stock. I can also use the discounted cash flow model to estimate the value of the company. And I can also use the discounted cash flow model to get the present value on the company that we're going to buy minus the price or the cost of acquisition is going to give me some net present value. Minus the cost is going to give me a net present value. And in the chapter, we start doing investment decision making using capital budgeting techniques, such as the present value calculation, taking out the cost of acquisition or cost to build the property. We're going to get the net present value. And if the net present value on the investment that we're looking at is positive, we're going to do it. We'll buy it and we'll build it. If it's negative, we're not going to do it. If it's zero, we're going to do it. And what I'll do is I'll go through a whole investment decision-making matrix that I designed so that you'll be able to memorize the investment decision-making matrix to be able to make investment decisions and then have these types of conversations at the board table with the investment committee. Because you may be pulled in at some point, you're going to need to understand this stuff. Because they're all going to be talking finance and marketing and ops and sales, you know, HR and restructuring and stuff, so you got to be able to converse with multiple people in different areas of the company at that level, at that meeting. So you want to be a participant in the strategic and tactical decision making that's done at the executive level within the firm. Okay, and that's pretty much it. Then you have basically the problems. I already gave you the solutions to them. So they're all just basic, you know, present value calculations. So they're pretty straightforward. Then you have the CAPM calculation. You get the stock price. You get the bond price calculation, so that's all you're going to do is memorize the equation, put the numbers in. So I've already given you the solution, so it's pretty straightforward. So you just memorize that. So
Will it be the exact same? Like, will that
it'll be exactly the same. Because what I'm trying to do is instead of having you struggle to do it, I'd rather have you memorize the structure of the solution so that you're memorizing how to do it the right way. That's why we did it for the extra credit problems and the homework. So you're just, and one's on the board, so you're just getting really comfortable with the math, and then it's just recurring. Okay. All right? All right, so I look forward to seeing you Monday. I will bring the blue books, okay, and the exams. Okay. What? Yeah, to do the exam, and then you'll be able to take it. We have the exam, right?
Yeah.
Next Monday, so it's over a 2-day period. So basically you come in and you put everything on the floor, and then I'll give you the exam in the blue book. And then what you'll do is you'll take the exam, And then, if you didn't study for the exam, you just gotta tell me, I didn't study for the exam, I need more time, I'm gonna go to the library and study because I didn't have time. And then you sit down and you take the exam. And then I collect the exam at the end of the Monday night. You go study some more, you come back on Wednesday and you finish the exam. Okay, so you basically have time to study, then you have 48 hours. Basically go back and study the stuff that you don't remember and come back and finish the exam. So usually the way that it works is everybody in the class, usually 75 to 80% of the class does really well on the exam. I go through all the exams and the deliverables, I make corrections, I do the grading, the stuff that's graded, you don't have to get back to me. You go back and review the videos and your notes, you correct your exam again after the fact, and then you basically bring it back and I'll grade it again. If you still have deficiencies in some of the details in it, even after you went back and reviewed everything and corrected everything, you will come to my office and sit down with me and I will walk you through the detail and show you exactly where you left some of the stuff out. But usually everybody does really well. The only people who don't do well are the people who didn't study. And I don't even care about them. Basically, if you didn't study, go study and then tell me when you want to take the exam and I'll let you take the exam when you're ready. I don't want you taking the exam when you're not ready. Don't waste your time, don't waste my time. You just say, Professor, I'm not ready, I need more time.